Every time Bitcoin crashes, the same argument gets recycled. This time is different. For the last 2 years, the story was institutional adoption. Wall Street finally showed up. BlackRock launched a spot Bitcoin ETF. Corporations started stacking it on their balance sheets, and the promise was simple. Once real institutions owned Bitcoin, it would finally start behaving like digital gold, a hedge that holds up when everything else falls apart. Well, in 2026, we got the test, a real geopolitical shock, real risk-off panic across every market, and gold did exactly what it was supposed to do. It ripped to a record high above $5,600 an ounce. Bitcoin, it got dragged down right alongside the tech stocks, and it's now sitting roughly 50% below the record high it hit back in October 2025. So how's Bitcoin's big grown-up institutional era actually working out? Not great. And today, I want to show you the real numbers behind why this happened, because it's not a coincidence. It's the entire thesis breaking down in real time. Let's start with what was actually being promised, because the pitch behind Bitcoin for years was that it was uncorrelated. You add a small slice of it to your portfolio, and when stocks crash, Bitcoin either holds steady or goes up, because it doesn't answer to central banks or corporate earnings. And between 2014 and 2019, that was actually kind of true. Bitcoin moved largely independent of the S&P 500 and the Nasdaq, and that's the entire reason institutions eventually got comfortable buying it, because if an asset genuinely doesn't move with the market, it's a real diversifier, and diversifiers are valuable no matter what they are. But here's what nobody in the institutional adoption camp wants to talk about. The same institutional adoption that was supposed to legitimize Bitcoin is the exact thing that killed the uncorrelated thesis. Once BlackRock's iShares Bitcoin Trust and half a dozen other spot ETFs started managing tens of billions of dollars, Bitcoin stopped being traded mainly by crypto-native holders and started being traded by the same portfolio managers who trade the Nasdaq. And when the same desks own both assets, they get bought together, and more importantly, they get sold together. By April 2026, the correlation between Bitcoin and the Nasdaq hit a record 0.96, and to put that in plain English, roughly 92% of Bitcoin's price movement could be explained just by watching what tech stocks were doing that day. A correlation of 1.0 means two assets move in perfect lockstep. Bitcoin was basically there. That's not a hedge, that's a leveraged trade everyone already had.
And you don't have to take my word for any of this, because we got a live stress test this year. When conflict escalated in the Middle East and oil prices spiked, markets panicked exactly the way they're supposed to during a real hedge scenario. Gold did its job. It kept climbing to fresh records. Bitcoin did the opposite of its job. It sold off right alongside the Nasdaq, like it was just another high-beta tech stock with a cooler logo. Analysts at places like CME Group and Standard Chartered had to publicly admit that Bitcoin's relationship with equities isn't some short-term glitch. It's become the dominant pattern for how the asset behaves under real market stress. And the timing makes it worse because look at what actually happened quarter by quarter. Bitcoin dropped 10.7% in January of this year. Then it dropped another 14.8% in February. Then in March, it barely scraped out a 0.19% gain, its first back-to-back quarterly losses since 2022. And remember, this happened while inflation was rising and geopolitical risk was elevated. That is precisely the environment where an inflation hedge is supposed to prove itself, where digital gold is supposed to shine the brightest. Instead, Bitcoin had its worst stretch in years, at the exact moment its entire value proposition was being tested in real time. Now, I already know what the bulls are going to say, because I've heard this argument before. They're going to say, look, there were a few weeks this year where Bitcoin actually held firm above $71,000 while stocks were getting crushed. Decoupling is starting, just give it time. And sure, that moment happened, but one good week doesn't undo a structural relationship, and here's why. The correlation between Bitcoin and the Nasdaq isn't some emotional mood that flips on and off. It's mechanical. It's built into how the money actually moves now. A handful of weeks of decoupling gets wiped out the second the next risk-off wave hits, because the structure underneath the price hasn't changed at all. And that structure is the real story here.
Institutional adoption doesn't mean Bitcoin became independently valuable. It means Bitcoin got absorbed into the same liquidity machine as everything else. BlackRock's Bitcoin ETF alone has accumulated over 800,000 BTC, making it one of the single largest holders of the asset on the planet. When the Fed signals higher rates for longer and risk budgets shrink, those same fund managers don't sell Bitcoin and hold their Nasdaq position, or sell Nasdaq and hold Bitcoin as a hedge. They sell both because in their spreadsheet, Bitcoin isn't filed under safe haven. It's filed under risk on, sitting in the exact same allocation bucket as the Magnificent Seven. Quant funds even run automated strategies that trade the spread between Bitcoin and tech stocks, mechanically dragging the two back together every single time they start to drift apart. Institutional adoption didn't mature Bitcoin into digital gold. It wired Bitcoin directly into the Nasdaq's nervous system.
And it's worth actually sitting with how wide that gap became, because the numbers aren't close. While Bitcoin was down roughly 50% from its October 2025 peak, gold wasn't just holding steady, it was setting new records, climbing about $5,600 an ounce and finishing the stretch up something like 80% compared to where it started the previous year. Two assets, both marketed for decades as the ultimate protection against chaos and currency debasement, and in the 1 year that actually tested that promise, they moved in almost completely opposite directions. If you were holding Bitcoin specifically because you believed it would behave like gold during a crisis, 2026 is the year that belief got a direct answer, and the answer was no. And this matters for a very practical reason, not just an academic one. If you're someone who allocated a chunk of your portfolio to Bitcoin, thinking of it as insurance, the kind of asset that's supposed to hold its value or even rise when your stocks are getting hit, you didn't actually own insurance this year. You owned a second, more volatile position in the exact same trade. An allocation sized like Bitcoin as a hedge is a missized allocation, because when the moment came for it to actually act like one, it fell harder than the stocks it was supposed to be protecting you from. So if Bitcoin isn't a hedge against a crashing market, and it doesn't behave like gold when it actually matters, what is it? Strip away the ETF marketing, strip away the digital gold slogans, and what's actually left is something economists have a name for. It's called the greater fool theory. The idea that an asset's price doesn't need to be justified by any underlying value or cash flow, as long as there's always a greater fool willing to buy it from you later at a higher price. Bitcoin doesn't generate earnings like a stock. It doesn't produce anything like a commodity. Its price has always depended entirely on the belief that someone else will want it more tomorrow than you do today. Institutional adoption didn't replace that belief with something more solid. It's the same thing it's always been underneath the branding, a bet that somebody else will pay more for it later. The institutional adoption story didn't change that. It just added leverage on top of it. Because now, when the same funds that manage your 401k's tech stocks decide to de-risk, they're also selling your digital gold at the exact same time. And that's the uncomfortable part nobody selling you the ETF wants to say out loud. Adding Wall Street to Bitcoin didn't make it safer. It just made it move faster in whichever direction the Nasdaq was already going. So the next time someone tells you institutional adoption is why Bitcoin is finally safe, just remember what actually happened in 2026. Gold did its job, Bitcoin didn't. And no amount of ETF marketing changes what the data already showed us. If you want to see how deep this concentration problem actually goes and which handful of funds now control enough Bitcoin to move the entire market on their own, that's exactly what I'm breaking down in the next video, so make sure you're subscribed for that one.